And we've got quite a morning in store. Obviously, it is tax time. I know it's tax time because I've heard from all of you about where are your 1099s. I trust every single one of you got them. If you didn't, feel free to pop it in the chat, send us an email, phone calls. As Ricky knows, we also accept smoke signals and carrier pigeons. So we want to make sure that everybody got their 2020 tax forms in the mail over the course of the past week or two. Excuse me. I know the Postal Service has been experiencing a few delays, so I'm not surprised to hear that people are just now getting them or got them yesterday or whatever the case may be. So keep that in mind. Obviously, we're getting ready for a really big event next week too. It is that time of year where we get together as an organization to advance our businesses by learning from the best of the best. And I mean family reunion, obviously, right? Family reunion's coming up next week. The event is Tuesday, Wednesday, and Thursday. Can be participated in entirely digitally, should you choose to, and everything will be available on demand as well. So if there's an event that just doesn't quite meet with your schedule, or you've got a lot going on already in your week next week, you can catch your favorite breakout sessions, keynote speakers on demand for a period of time after the event. Also, and well, it's about time that we get a chance to reunite as well. So here at the Lone Tree Market Center, we are hosting some in-person events also. Tuesday, Wednesday, and Thursday morning, all of the main stage sessions will be open. You can pop into the training room. We're going to have, we have some sponsors who are bringing, doing some grab and go refreshments and lunch and things like that. And then we're getting together on Wednesday night for a really special Red Bash celebration. We've got an awesome happy hour planned that includes everyone's favorite, some friendly competition. We've got a trivia event lined up that evening as well. So lots of fun stuff. More and more and more information is on the way for that. And so keep an eye out on the Facebook pages. If you are in Highlands Ranch or Summit County, then take a look at what your market center is doing, because I know we've all got some different events lined up. But we have a very special guest with us today, Mr. Jerome Geinger. You guys might be familiar with the name. He happens to know this crazy OP of ours just a little. He might be responsible for this crazy OP of ours.
It's his mom. It's his mom.
It's all his mom. It's all his mom. Well, you know, Jake is definitely responsible for introducing us to the opportunity to be in business with you. And obviously Jerome represents our market center and the Highlands Ranch Market Center from a financial standpoint, but he also works with a fair amount of real estate agents and small business owners as an accountant and a CPA, right?
Correct.
Wonderful. And it's tax time. So, Jerome, you're here to talk to us a little bit about what that looks like from a real estate perspective and how we can best prepare ourselves this time of year.
All right, we can do that. And definitely want to make it, if you got questions or comments, jump in at any time. For us tax folks that do this stuff for a living, it is real busy through April 15th. And the way that we can best serve our clients is our clients getting the information in as soon as possible, as well as getting it in a manner where it's fairly easy to look at. We hate this time of year, especially when it gets closer to April. All of a sudden, the client says, "Oh my goodness, I got to get my tax return done. Here's my shoebox and figure it out." It doesn't work out very well for both sides in that respect. So we'll talk about a few things there on what you can do to help there, as well as things that you should be looking at. But I thought I'd start out first with with, you guys have all heard about the payroll protection program. That was something that came out last March with their first go around. And what the payroll protection program did was it said that, you know, if you're on a team and you have employees that you're paying salary to, there's a way that you can get some money from Uncle Sam or from the Small Business Administration to help you meet some of those costs. Now, they didn't just limit it to those people that have employees. If you're self-employed, so if you're have a Schedule C, is how you report your income from Kelly Williams, then you qualify for that as well. And so if for some reason you didn't take advantage of that last fall or last spring, then you have another shot to take care of that now. But you want to do it as soon as you can. So what does that mean? For, you know, a lot of the people that I work with are Schedule C employees, or Schedule C is how they run their business. So it's very simple. I had one that I just worked with about 3 weeks ago where they didn't apply for this PPP program last spring. Fortunately, in December, they expanded it so that you could still, they have a second bite at the apple for those people that are in that regard. And all that individual had to do was provide them his Schedule C, fill out a couple questions in the form, and a week later, you got a check for $20,000, tax-free, free money. You don't have to pay it back. It's yours to use and do with whatever you want to. So if you have not taken advantage of that, whatever bank you're associated with, I would get online with them and see if that's something that you can take advantage of now, and do so sooner than later. There is a limited amount of funds, although limited amount of funds in the government realm is lots of zeros behind it. It's like $250 billion is available out there, but a lot of people did not take advantage of that the first go around. So if you did not, and you have a Schedule C from either 19 or 20 that shows a profit on your bottom line, then you want to get on the horn with your bank and see if you can get that taken care of. Now, I said 19 or 20. They said the program was based off your 19, but they will take your 20 Schedule C as well. Why would we want to worry about that? Well, perhaps 20 was better than 19. So you want to use the year where your Schedule C is going to have the most income, because it's roughly a little over 20% of what that line is that you can get up to roughly $25,000 on a Schedule C. If you have employees that you run through your Schedule C as well, then you can take it, you'll get more than that, because you'll get a percentage of whatever that employee wage was. Not independent contractors, but it has to be a W-2 that you would have paid out. So I kind of ran a lot there. Does questions on that piece of it yet, on the PPP piece?
I have one, Jerome. You
Yes.
said get in touch with our bank. Are we better off going through our bank or going through our CPA?
Well, the banks are the ones that have the forms, and they're the ones that have the funds. So you can talk with your CPA, especially to make sure that you're looking at the right numbers. But when it comes to the actual application, there are a couple of CPA firms out there, not very many, but it's usually the banks that are handling that. If you don't have a good banking relationship, they can get it done sooner than later. I know that, you know, Quicken, a lot of other places out there. If you use American Express, I know clients that have gone through American Express because of their credit card relationship have used them. But I know Wells Fargo is the one that this individual that I talked about went through, and within a week, they had a couple questions. A couple days after he put his information in, he got those answered quickly, and within a week, he had money in his pocket.
Cool, thank you.
Anything else on that? Okay.
Jerome, not on that question. I mean, not on that, but would you do me a favor and in the chat, put your name and the name of your firm and your phone number, because I do the productivity coaching, and I ask the agents to go and talk to an accountant who's familiar with real estate agents, because all accountants are not equal. Okay.
Yeah.
And that way, do you have other people in your firm that handle taxes besides yourself?
Yes. Yeah. We've got a team of about 12 of us. So.
Okay. So if you could do that, then all the I have a lot of people on here that are new. And so they also need, one other question, do they need, do you have an attorney that does full corps and sub-S and LLCs if that account, if that person wants that? Do you have a name of a person who does that?
Yep, we can do that. Anna, do you want to take care of that for me? She's got all my information.
Oh, great. Okay.
Yep, absolutely. We'll get it all put in.
Okay.
Yeah, I just want to be sure everybody's on the same track, because I really am pushing, get an accountant.
Yep, yep.
Thank you.
So, so again, go back to the PPP just a little bit. We talked about if you're a sole proprietor and you're on a Schedule C, if you have a team and you run it through an S corporation or a partnership or anything like that, same thing still applies. If you haven't applied for it, then definitely go in and take advantage of that. You'll be able to, and it's limited up to $100,000 of compensation. So if you make 120, you're going to be limited to 100 for you, but all of your employees up to that $100,000 can get thrown into that mix. So if you got $1 million of payroll, we're talking, $200,000 of PPP money that could potentially come back to you. Actually, it's more than that, but that kind of gives you an idea of the range we're talking about. So get that done. Now that's PPP number 1. For those people that did apply for it originally last year, probably more so from an entity standpoint, but potentially from you as well. If for some reason, if you applied for it last spring and you got your money and you're doing great, they also now have a second tranche that you can go after. And the way that you can get some money out of this second go around, again, tax-free money, is that you have to be able to show the SBA that your revenues between 2019 by quarter decreased at least 25% in any one of the 4 quarters. So, if your collections are down, go back and take a look and see if you could show in any one particular quarter that your revenues were down 25% in 2020 from what it was in 2019. And if that's the case, then you may be able to get some more money out of the SBA on the second go around. So look at that. Any questions on the PPP piece? Any more questions? Okay. There is one other thing out there that's related to that came out, and that's what they call an employee retention credit. Again, this applies only if you have people that you issue a W-2 to. This one's a little bit more difficult to get, but you can get a credit for some of the compensation you paid to them. But in order to qualify for that, you have to have a 50% reduction in a quarter of revenues. So there's a 25% test for the second tranche of the PPP. There's a 50% test for this retention credit. So again, keep that in the back of your mind. And as Donna said, you got some questions to ask your CPA if you think you may qualify for any of those types of things. All right.
Can I ask a question real quick?
Yes.
And this isn't for me, but it is for an agent that I spoke to for quite a while yesterday in our office. Would that also apply for virtual assistants?
Virtual assistant, well, are you paying them a wage?
So this isn't for me, so this would be for her, but I know that the gal that I talked to yesterday is paying, it's a monthly,
Okay.
and it's a company that she pays,
Yeah.
and they pay the virtual assistant, but I know that based on my conversation with her, this could be really helpful.
Yeah, probably not. And the reason probably not is she has to be the one that issues the W-2.
Gotcha.
Or to qualify for her. Yeah.
Okay.
So if we're paying somebody else to do that for us, that's more of a 1099 relationship, and those don't qualify. And so if you've got somebody that you may have another assistant or somebody that helps you do some of the work up there, but if you're paying them through a 1099, then that won't qualify. It has to be a W-2.
Okay, thank you.
Okay. Anything else? All right. Well, let's talk a little bit about taxes and the things that'll help out with getting things put together. I know in the past, you know, I've got another one that we kind of put together that talks about different types of entity structures and that kind of stuff, but we'll kind of stay away from that for right now. We'll get more into the record keeping and things that you need to be thinking of to get things put together. And if I hadn't hammered it home enough, you know, the sooner the better. And especially if you think that 2020 might be better for you, because they do, you know, on the PPP, if you hadn't applied for it, they do ask for a copy of your Schedule C that you may be applying for 2020. It doesn't mean you have to have the whole tax return filed for 2020. Just get that information to your CPA or your accountant so that they can prepare the Schedule C for you and get you a copy of that so you can upload that and get it to the SBA if that's the case. So getting stuff together, you know, Quicken, QuickBooks, Excel, anything other than probably something that's handwritten on a ledger sheet, that's the way to go. We'll take the ledger sheets, but you know, then we have a problem trying to understand your writing and my handwriting. My handwriting, and Anna's probably seen Jacob's, is very similar. So if I write something down, a lot of people don't understand what it is. I do, but some others may have a problem with it. So it's just making it easier for the individuals that are involved in the process. You know, 1099, you'll receive those, of course, as Anna talked about. It depends upon the CPA you're working with, how much information they want to have. My approach is, if you give it to me on a sheet of paper, it's correct. May not be, but that's the approach that I'm taking. I'm not going to sit there and I'm not going to say, show me the 1099, show me your bank statement, show me your receipts for your meals and entertainment, show me your mileage log. If you got it on a sheet, then that's what I'm going to go with. I may ask you a question about it, especially if I'm looking at this year versus the prior year, and I see a huge increase or a huge decrease. If I see a huge increase, I see revenues going up as well. Well, that'll make sense. That my expenses should probably go up as well. If I see a huge decrease and revenues are the same, well, I'm going to ask you why, because I want to take advantage of the stuff that's out there. But that our approach is primarily to rely on the information that you provide to us, because I'm not going to go back to it. I'm going to assume that you can put things together, but I am going to ask some questions if I'm seeing things that aren't that I've seen with others that you may not have from an expense standpoint, or if you know things just don't jive. So expenses. You know, we've talked about it before. What's marketing? What's gifts? For realtors, that's probably one of the biggest things. And I know that it's discussed a lot in some of your groups. But you know, make sure that you know that $50 bottle of wine or that $80 whatever it is that you give to somebody for a closing, that it's got some sort of a marketing logo on it, because then we can deduct the full amount. If not, we're limited to $25 as a gift. Those are little things that the IRS gets quirky about for one reason or other, but at least we have something that we can try to show them that it's a marketing tool and not a gift that they've received. So we're not limited on the types of things that are there. Meals and entertainment. Well, you know, take advantage of it. You know, if you're out driving around with people that are looking homes and you stop for lunch, well, then by all means take care of the lunch and know that it's there. Again, keep that record in your file. It doesn't need to be provided to me, but keep that record in your file so you know it's there. You know, put down who it was, when it was, and what it was for. And just write on the back of the credit card slip and you're set and ready to go. Now for 2020, unfortunately, because of other rule changes in the prior years, you're still limited to 50% as a deduction on that meal. 2021 and 2022, that limitation is taken off. So it's 100% for 21 and 22. So remember, 2020 is still 50%, 21, 22 for now anyways. We'll see what happens with the new regime back east if they start making changes to that again, because they can. But right now it's 100%. Entertainment. So taking somebody out golfing, you know, going to a ball game, you know, going to a play, whatever it might be, opera, whatever. Unfortunately, those things are still not deductible at all. So you just have to keep in mind, even though you may talk about business all the time while you're there, it's still not deductible as entertainment. If you buy a meal before or after, or you have refreshments during, then you can get 50% for the meals that are associated with that. Automobiles. That's there's the two ways that you can deduct your automobiles, and that's you can use the mileage method, or you can use the actual cost method. And it really depends upon the individual and the type of vehicle that you got, how much, which way you want to go. The mileage method is of course the easiest. You just keep track of your miles, driven during the year, how much was for business, and you take that times like 57.5 cents for last year. It's gone down for this year. I think it's gone down 1.5 pennies to 56 cents for 2021. And that's easy to do. You just take that deduction. Then you don't have to keep track of how much you spend for gas, what did I pay for repairs, what did I pay for maintenance, what did I pay for new tires. That stuff is all taken care of in that 56 cents a mile, or 57.5 cents a mile. Now parking, tolls, that's on top of that. So when we're talking about the 56 cents a mile, it's just your basic operations of the vehicle, not anything outside of that. So you still keep track of those. And again, I always hammer that if you can get get the app that tracks your mileage, that's the best thing for you, because then you got it taken care of. And if the IRS was to come in and ask, that's what they're going to ask for. So apps are easy to use them. It takes care of a lot of issues. And when I say it takes care of a lot of issues, the more that if the IRS were to come in and look at your stuff and ask for backup, little things like that will lead them away from looking at things that may have a more of a question in it, because they're seeing, oh, yep, they are operating in this business. They've got a person, they've got a business account, they've got a business credit card, they're keeping track of the mileage on this app. They've got some receipts, and if you have some receipts, it's best to have all. But if they're looking at some and they've got them there, then they may tend to not look so closely at some other things that could potentially have a question on your financials. So again, little things like that just help, and it makes it easier for you instead of trying to go back and say, oh my goodness, what was it? You've got that information at your fingertips and it's ready to go. What else can we, going back to the automobiles again, that's the safe harbor, is using the miles method. Still go out and you can buy that nice vehicle that you want to have. Luxury automobiles, the IRS used to limit that to $18,600. Was anything above that was a luxury automobile. Last year they changed that to $50,000, making a little bit more sense. So there's the benefit of that is the one-time hit at the very beginning of purchasing a vehicle. You can get a huge tax deduction in the year that you purchase that vehicle through depreciation, and that'll already help. But then that means from that point forward, as long as you're using that vehicle in the business, you have to keep track of actual costs, actual gas, actual repairs and maintenance. Still have to have that mileage log just to go along with it, because if you haven't used it 100% for business, then you have to be able to show the IRS, if they were to ask, how much that was for business use and how much it was for personal use. So we take that percentage. So again, if I haven't hit the mileage log enough, I'll hit it one more time. So that you've got it there. Any questions on that so far?
Per usual, Jerome, I have lots of questions.
Yes, that's fine.
As far as the car goes, is it true that once you got like your first year in real estate, and whichever way you go with your car deduction, that you have to keep it that way for the entire time that you use that car for work?
That you use that car, correct. That
so like if I take my first year and I use the mileage, then I have to continue to use the mileage right up every year that I have that car.
Correct.
And then if I get a different car, then I can change it the other way if I want, but whatever way I go, I have to leave it.
Right.
Okay.
That's correct.
Thanks.
Now with the vehicle that you purchase, again, you need to make sure if we're taking the actual cost and we're writing it off that first year, you need to make sure that you at least use the vehicle 50% for business for the next 5 years. If for some reason it drops below 50%, then you have some recapture of that deduction that you took for the depreciation on the car. So they could come back and try to say, well, it went from 80% to 60%. You should recapture that as well. It's not a big of an issue. But if it does drop below 50%, it's a difficult row to hoe. So make sure that you keep that up there. Now you can have two vehicles. You could have one vehicle that you use primarily for business, but you may have another vehicle, and that may be that Beamer or whatever it might be. But you may have another one that you're using, especially if you're up in the mountains and you need something in the wintertime to get around that has a little more traction. You may have another vehicle, a Toyota 4Runner or whatever, RAV, whatever it is that has a four-wheel drive. You can use that vehicle as well, and keep track of that on the mileage method, so that you don't lose out on the full deductions that are associated with those. So, okay, any more questions on autos?
Yeah, Jerome,
Yeah.
What's the difference, or is there a benefit versus for owning the vehicle as an individual or owning it through your business?
Really there shouldn't be an issue. Again, that goes back to, am I running a business, and what can I show the IRS? If the IRS to come in to look at it and they're seeing a vehicle and it's in my personal name, they're saying, well, it's your personal car. Well, yeah, it is, but I use it primarily for business. But if they see it in a business, that look and feel is a little different. We'll go back to and kind of hammer that home a little bit further. Is if you're using your personal credit card for your business, stop it. Just stop it. Don't do it. Because if the IRS comes in and does an audit and they're seeing a personal credit card and you're breaking out costs, all of a sudden, all those meals you had, that's personal. That's where they're going to start at. It's personal because it's a personal credit card. So if I can't say it's strong enough, get a business credit card and use that for your business. And make sure that's what you're using exclusively for the business, and keep that out of your personal side, because that's the easiest thing for an agent to come in and say, hey, it's a personal credit card. How am I supposed to know that this isn't all personal? How am I supposed to know this is business? So if I can't hammer it home enough, get a business account set up and run it as a business and run it through your personal credit card. You can still get your miles and all that kind of stuff on a business card, just as you can on a personal card, but the IRS is going to eat your lunch if you have it on a personal card. That's where they're going to start.
Thank you for saying that, Jerome. I don't think I can pound that enough into the new people. Please don't do that.
Yeah, I've had it and I still see it now. When I get that's if I get a new client, I see that's the first thing I tell them, because I've been doing this for too many years, and that's knowing how the IRS works. That if they see something on a personal card or a personal bank account, and you're running a business,
I have a question, if you don't mind.
Sure.
So I just purchased a car completely for the business.
Yep.
As of course I bought it under my name.
Yep.
I couldn't put it under my business because that's how it works. And they said, once it's paid off, I can put it under my business.
Yep.
So how do I deduct that?
Yep. And that's not too dissimilar. I mean, with a car, what it's going to go back down to there is if the IRS has a question, whatever the vehicle might be, whether it's in the company name or the business name, they're still going to go back to the log. They're going to say when they come in, when they first come in, they start out with, give me everything that you got. And then if a good CPA will come in and come back to them and say, okay, let's be reasonable. What do you really want to look at? Well, they're going to look at your automobile usage. They're going to look at meals and entertainment. Those are just top, because those are the top things that are easy to find a thing. And so if you can come in, whether the car is in your company name or your personal name, and have a log that shows the business use of that vehicle, then they're going to pretty well back off of that as a question. So just make sure you got your log in place so that you can break that out.
Okay, thank you.
Okay. Anything else on that?
I have something that goes along the lines, like a question along the lines of that line between personal and business, but it's not about automobiles. And I don't know if you'll touch on this, So if so, just tell me. You're going to get to it later, but I often see agents will have commission checks cut to them personally. And now, does it matter if I take that personal commission check and put it in my business bank account, or should I still have it written to my business?
Well, part of it depends upon how you got your business set up. I know a lot of realtors, their businesses are under their personal name. They don't have a company set up per se for it. So that's not a problem. So that just goes back to when you fill out your Schedule C, usually that's where that's at. So it's in your social security number. Schedule C, you can have your social security number that it's issued to, or you could have a business name. So you could have Anna Kibble doing business as I'm a Great Realtor LLC.
Right.
Okay. And you can have it made out to I'm a Great Realtor LLC, which is what it would best be suited for, because then it's going to your business again and it's showing up as a business. If you get it in your personal name and then deposit it in your business account, it's not a problem. So, but it's best to be as consistent as possible with these things. So if you've got commission checks or checks coming in from for different things you're doing, that it's in the business name and the business employer identification number if you have one set up for it.
Good. Thank you.
Okay. All right. Anything else on that? Again, questions, just jump in. Family members. I always hit on this. I've got kids, grandkids. My kids have kids, so that are in the business. How can we utilize them in the business so that I can pay them something and get a deduction for it? And not saying that I have to give them a check. Our kids all have activities that we're paying for one way or the other, and I'm of the bent where that's great, but I'm not just going to give it to you. You can earn a little bit of it on your own as well. That's always been my approach, and it's worked out for the most part. And they can help you out in your business. So, it's got to be reasonable. A 4-year-old can't do what a 16-year-old can do. Okay, but they can do something. So if you've got an office in your home and that's what you're taking, they can clean your office. You can give them a few bucks a week for that. And that's a deductible expense for cleaning up what you got. What it used to be back in the days. Well, I'm still seeing the signs out on the for sale signs there. Sometimes they get messed up. Well, they can pull out a rag and clean them up. When they're 4 years old, and when they're 16, they can be out with you hammering them in. Look at what's reasonable. If you're as long as you keep that amount to them under $600 for the year, you don't have to issue them a 1099, and there's no filing requirements for them. So that's $600 that you paid out of pocket for something that for dance class or piano or soccer or football, whatever it might be, that you had them do a little bit of work for you to earn at least a portion of that, and you can deduct it now because you're paying them for helping you in your business. And again, if you keep it under the $600, then it's fine. You can go over that amount, but then you have to worry about self-employment tax. Maybe not any income tax, but the child have to worry about self-employment tax on that amount. If you pay them through a wage and you're a sole proprietor, so you got your Schedule C, well, then I can pay him $5,000, up to $5,000, almost $6,000 a year now, and it's tax-free. Don't have to pay Social Security tax. Don't have to pay Medicare tax. Don't have to pay income tax. Treat him as an employee, issue him a W-2. Don't have to pay any of those taxes on it. You now got a $6,000 deduction on your return. The older kids, that may be something that they can really show that they do quite a bit of that work for you, and they work in it. I know some of these camps are not cheap, so put them to work for you and make them work for it. And now you got a deduction for that. Now, and on both sides, whether they're self-employed or whether they're an employee, you also have the opportunity now, if you still say, well, I don't want to pay for that. Well, you can stick that money away for them into a Roth IRA. And they can have money starting to grow now for later on down the road, or into an IRA if you want to do it that way. But you can put it into some sort of retirement vehicle for and they've got a little nest egg for sometime down the road. So things to think about with that in family members and how they can work for you. Also, speaking about retirement, there's a lot of different vehicles out there for you to put money into. So if you've had a good year or a better year than last, and if you're thinking about putting some money away, you're thinking you may not be selling real estate when you're 85 years old, although we have some that are and are still successful at it, which is fine. But if you think that you might want to slow down by that point in time, then there's various vehicles out there for you to put money away into from a retirement standpoint. So think about those again. There's IRAs, there's Roth IRAs, there's 401ks, there's simple self-employed pension plans. If again, those are things to talk with your accountant about and see, is it, sort of be putting some money away into that, or and especially in a great year, when you're having a great year and your tax level might be in the 30 or plus percent or 25% plus, perhaps it's time to think about putting some money away into that so that you can at least defer some taxes on it and perhaps get away from not paying any tax on it at all and have a deduction for it perhaps. So a lot of different options out there. Little things to think about when you're running your businesses. I'm out getting XYZ, is this ready for business? So those $60 pair, $100, $120 pair of Bolo sunglasses that you got to have. Well, some people will say that's for business, and very well, rightfully so. I mean, you got to be able to take care of the sunglasses when you're not driving your clients around. You don't want to run into something. So how do I make that from a personal expense into a business expense? Think about, yeah, I may be using it partly for personal uses, but if it's primarily for business, then stick it on there and let your accountant tell you that you should or shouldn't. I've got a client, unfortunately, with the same last name, who tries to take advantage of that as much as possible. So I have to slap his hands every once in a while and say, okay, we've gone a little too far. As I always tell them, pigs get fat, hogs get slaughtered. So we'll be piggish, but we're not going to be hoggish. But he also does his job in pushing the envelope just a little bit, and then we come back and we have to take it to the right spot. So you can always ask. You can always ask if it's deductible or not. Now, they may put you in your place, but you can always ask. So if they're not letting you ask, then you need to talk to somebody else. So I've talked a lot. Is there any questions that people may have on what we should be doing from the realtor standpoint?
Jerome, go ahead, Reem.
Reem?
Oh, could you please explain about medicals? I know it's a little weird to ask, but it is concerning, such as one, not only per se my expenses, but my daughter's expenses or something like that. Okay. They all deductible.
Yep. So there's two parts of medical. There's a health insurance premium, if you got that, and then you got your out-of-pocket costs that you may have to pay separately from the health insurance premiums. The health insurance premiums themselves, because you're self-employed, or if you have an S corporation and you're an employee of the S corporation, the nice part about that is, for right now, is you'll be able to deduct up to your income level the premium that you pay. So what does that mean? If I paid $15,000 during the year for health insurance premiums, and if my Schedule C shows a bottom line of at least $15,000, then not on my Schedule C, but on the front of your tax return, there's a specific line for health insurance, self-employed health insurance premiums. You'll be able to deduct that $15,000 of health insurance premiums to reduce your income tax, not your self-employment tax, but your income tax. So that would be there for you to utilize. And that's one of the nice things about being self-employed, or if you're an owner of an S corporation, as long as you, between your wages and your S corporation income, you've got at least that $15,000 of income, then you'll be able to deduct that. That doesn't apply to the majority of the people in the United States because they don't meet that requirement. Those, if they're paying it out of pocket, premiums, and or if you've got other costs that you pay out of pocket, so you're paying for dental, all your out of pocket costs that you may have, your deductibles, that kind of stuff, that goes on to your Schedule A as an itemized deduction. And then they look at what your income is and reduce. They don't give you that full amount. So if your income is $10,000, they're going to reduce your itemized your healthcare related expenses, personal healthcare, by $750. So if you had out of pocket of 1,000, well, you only get to deduct 250. If you had out of pocket of 750, you don't get to deduct anything. So it's based upon what your income is on how much you get to take. If you can itemize your deductions and take advantage of that. With a large standard deduction now, most people don't itemize. You always look. I recommend that you always look at it, but most people don't itemize because they just don't have enough to meet the $12,000, $24,000 standard deduction that they get. So, does that answer your question?
Thank you.
Okay. Yep. Any other questions? Yeah, I'll chat just briefly about structures. Again, we talked about sole proprietorships. We talked about, well, let's start with LLC. That's what people always hear about is an LLC. And an LLC, it's a legal entity, but we get to decide from a tax standpoint how we want that LLC to be treated. So what do I mean by that? Well, an LLC from a tax reporting standpoint can be a sole proprietor. So if it's just you that's in there, it can be a sole proprietor. If you've got two of you in there, it becomes a partnership. If you got two owners, it's automatic. It becomes a partnership in Colorado. California, as a community property state, if it's husband and wife, they can still treat that as a sole proprietorship. But in Colorado, if you got a husband-wife owner, we have to file a partnership return. It can be a C corporation, which I'd never recommend, or it can be an S corporation. And an S corporation, of course, there's benefits to that. There's benefits to a partnership. Those are things that you're going to want to talk to your tax professional about. Is what type of entity structure should I have, and when should I make a change? You can start out with one type of entity structure and change it later on. So there may or may not be tax ramifications associated with that. You just have to see, again, talking with your tax professional if there are or aren't. So. They've all got their benefits and their detriments. If there's two of you from an income tax standpoint, if there's two of you in the or more in the entity, it depends on how you want to take care of profits. Partnerships are very easy to, even though you may be a 50-50 owner, in a partnership, if one partner does more work than the other in a given year, well, you can say, well, okay, well, we're just going to give you more this year of the bottom line. And it's not a problem. In an S corporation, it doesn't work that way. If you're 50-50 owners, whatever the bottom line is, and if somebody else has done more work, perhaps they should be compensated more. Well, you have to pay them more in a wage than the other partner, because whatever my bottom line is, my bottom line net income has to go out based upon how the stock is owned. If it's 50-50, it goes out 50-50. So you have to discriminate for the owners based upon in compensation, which can be done. The question is how much is that? And the benefit for the S corporation versus the others is, for right now, you save some self-employment taxes. Your Medicare and Social Security taxes you can have some tax savings there. For now, has an effect on your Social Security later on, but those are things just to be thinking about as you're talking about it. And again, you can start out with a partnership when you're first struggling and things are going along. You're making ends meet, but you're not doing great guns. And sometimes people will then change to an S corporation when things just blow up and things are successful from that point on. So there's ways to do that. A little bit more difficult to change from an S corporation to a partnership, but it can be done. Especially in your world, where it's just services that you're working with. If you got assets in the company, it becomes a different issue for an S corporation. So. Questions on structure? Okay, and again, that's for the realtor world. If, like most realtors, they're usually thinking about investment properties down the road. Never use an S corporation for an investment property. It just does not give you the tax flexibility that a partnership does. So that would be my recommendation. Other things that you might think about, you know, a lot of you probably worked from home last year. I mean, you may have, you know, some of you have spaces at the office, but if you're still doing a lot of work from home as well, definitely look at an office in home deduction. There's two ways to do that. There's again, the IRS gives a simplified approach, which just says, I use this place exclusively for business. It was 160 square feet. They take 160 times $15, I think it's $15. And that's the deduction that those take. It's better than a stick in the eye. You get something at least as a deduction for your office, and it helps reduce your income and your self-employment tax. The other approach is to take actual costs. And just like your vehicle, again, you take your actual, and you don't have to own the home to take the actual cost method. If you're renting, if you have a 10% of your space in your where you live is used for business, and again exclusively for business is what the IRS says, then you take 10% of your rent, take 10% of your utilities, take 10% of your upkeep, and your repairs and maintenance. You take that as a deduction. If you own the home, same thing. You can take 10% of your interests, 10% of your taxes, 10% of, again, all your upkeep, and 10% of, if you want to depreciate the property, you take 10% of that cost. That all comes in. Usually gives you a bigger deduction. It also gives the IRS a little bit more opportunity to come in and say, I want to look at your return. That's just one of those flags that those things that kind of queue up if or when they might look at a personal tax return for whatever may be in there. You know, the nice part about using the actual expenses now, especially when you own a home, is you'll get some of your interest in taxes in addition to the standard deduction. If you're not itemizing deductions, the standard deduction is exceed your itemized deductions. Well, you'll get some of your interest in taxes at least as deduction, because you'll be able to take it as a deduction on your business, where it'll just go away on your individual return. So a lot of general discussion. Anything else in specific that you may have a question on?
You know, I think one of the questions that I would have is, you know, you had mentioned briefly investment property ownership and how that's going to look different than my real estate business. I know we have several agents who own investment properties and more who are on the Zoom today who are working on that, or you know, are looking for their first, or may have purchased their first last year. What kind of variants are there? What do we need to be aware of?
Okay. On investment properties, and since you're a realtor, you've got you get a tax benefit from being a realtor with regard to rental properties. And what happens, and usually the first few years, rental properties, they're taxable. They have a taxable loss. Not they may cash flow, but because of depreciation, you may have a taxable loss. And that's not abnormal. That's usually how it is. Since you're a realtor, you're considered a real estate professional. Congratulations. And because of that, you get to take that loss against your income, your other income that you might have. Again, so if you're a realtor and you're Schedule C, you got $100,000 of net income that you made from your Schedule C. Got to pay self-employment on that whole $100,000. Comes to the front of your tax return, you can reduce it. Let's say you had a $15,000 loss in that rental real estate. Your income tax is now not on 100, but it's on $85,000. You get to reduce that by that $15,000 loss from your rental property. So that's a real benefit for you. Now, And if you're married from a joint return, or however that's set up, if you're in a higher income bracket, that can really make a big difference, because it doesn't matter what your spouse may be doing to generate their income. Because you're a real estate professional, you can deduct that loss against whatever other ordinary income that you might have, which is a great answer. Now, again, reporting. How is it reported on your individual tax return? If it's just you that owns the property, it goes on what they call a Schedule E. Page 1 of Schedule E is just for rentals and royalties. And what you'll have on there is the rent you got for the year, all the expenses associated with it, and then your depreciation expense, which is the big thing. The nice part about residential rental, it's you divide your cost by 27.5. That's the life, what the IRS says the life of a residential rental property is. Even though we know it lasts longer than that, that's what they say. So if you pay $275,000 for a rental property, let's say $300,000 for a rental property, take out some land, so we're down to $275,000 for the building. You're going to get a $10,000 deduction on your tax return for depreciation. Okay, so you may end up from a cash flow standpoint at $5,000 of cash flow. It means your cash has exceeded your expenses, but you'll end up with a $5,000 loss because of that depreciation that you'll be able to take. So again, nice thing. Another nice thing about that is when you go to sell the property right now, that's taxed at the capital gain rate, which may be less than your ordinary income rate that you may have gotten that deduction for. So there's some benefits there. So again, if it's just you that owns it, Schedule E, page 1 of the Schedule E as the owner. If there's 2 of you that own it, then we've got, if it's in a husband's and wife's name, as not through an LLC, but as individual owners, still goes on Schedule E, page 1. If you now have it in an LLC, and there's more than 2 people in that, or 2 or more people in an LLC, we got to file a partnership return. Again, because I'm not going to use the Schedule C, an S corporation. You got to file a partnership tax return. K1s come out, are issued from that, showing your income or loss for that year. It goes on page 2 of the Schedule E in the same way. So, and again, the beauty of being a real estate professional is I may have my spouse in there as a partner. And so I get a $5,000 loss. She gets a $5,000 loss on her K1. So we got a total of $10,000. I can make election to treat my wife. I can say that my work as a real estate professional carries over to my spouse. And so I'm able to take that full $10,000 deduction. I'm not going to have to limit what my spouse's K1 looks like. So again, those are just elections that you make when you file your tax returns for those first years. So talk with your tax professional about what that needs to look like. And you'll be able to utilize that. Anything else on that? All right, anything else, Anna?
Awesome. I don't see any questions in the chat. I'm sure what's going to happen is as soon as we get off the Zoom, somebody's going to be like, oh, what about so Jerome's contact information is there in the chat. Make sure that you grab that. His phone number and email are there. And if you're not working with a professional to file your taxes this year, I highly suggest waiting at least 6 weeks that you do that. Right, reach out to Jerome, get somebody on your team.
I have a quick question.
Yes.
So this will be the first time I'm a new agent. So this will be the first time. I've only done one transaction last year, and I'm starting to build up my business more this year now. So I only have one thing to claim.
Now online, they recommend using this to really
begin also,
tooth portion of it will always remain outside of your body.
Can we get that?
Can we also use on our taxes, like how we pay SMEDRA, CTM? Can we also put that on our taxes, or no? Like all the money that we put out towards our business, can we claim that on our taxes?
There's some background noise from somebody else. So Jackie,
That's what
can
I
you
heard.
say the question again?
So I'm a new agent, and so this will be the first year that I'll be filing. And so I was wondering, can we also claim all the fees that we put out as far as being involved with SMEDRA, paying our CTM, our
Yeah.
office? Can we also use that?
Yeah.
Okay. Okay.
Yeah.
All right. Perfect. Thank you. I will be contacting you
Okay.
to find out more information and everything. Thank you.
Yeah.
This was wonderful. I'm so glad I was in today's meeting.
Okay.
Thank you.
And then Bonnie had a question on partnership versus sole proprietor. It really depends upon if there's more than one of you in there. From a liability standpoint, and this is going to, talking with Damien, who does a lot of the legal stuff for Keller Williams there. Since there's legal liability issues, there's tax issues, and there's certain legal liability issues that you can help defer by being in an LLC. There's some things that being a realtor, that even if you're an LLC, that it doesn't afford you the same protection because it's a personal service. So those are things that, I'm not a lawyer, that you need to talk with the lawyers about, but I always recommend at least having an LLC structure, because whatever protection that an LLC can give you, at least you've got it set up that way, and it will give you that protection. It may not be carte blanche and 100%, but if it gives me 20% protection, more protection by being an LLC than being a sole proprietor, well, that's 20% more than what I had before. What that kind of comes down to is, what are they going to sue you for? If it's something that happens in the vehicle, well, hopefully you got the right insurance and those types of things that will keep your personal assets out of it. If it's something that happens while you're at a showing, or something happens from a personal standpoint, that's not going to help. So, okay, anything else?
May I ask a question?
Yes. Rip?
So if you don't mind, like, this is basically the second time I'm gonna put tax. Would it be better if I do with my husband, or we do separate? So I may not understand very well that, but he has better income than I do so far. And if you don't mind, like, about the loss on properties that we own for rent.
Okay.
You mentioned that we can both claim the loss. Is that correct, or am I understanding wrong?
Okay. As far as married filing joint, married filing separate, you're really going to need to look at what gives you the best answer. For most tax answers, married filing joint is usually a better answer. Now, where that doesn't apply is if you've got large student loans. I have a few clients that, because of student loans, they'll do married filing separately, because the loan payback on student loans is based upon then that person's income. And if they're the lower income person, then they can reduce the amount that they have to pay back on their loans. So it's not a tax answer, but it's tax related. So you really kind of have to look at it. But for the general answer, married filing joint is usually better than married filing separate. There may be other reasons. I've got a couple clients that do married filing separately because they don't trust each other from a tax standpoint. and somebody may be much more aggressive in what they're doing from a tax standpoint than the other spouse, and they just as soon not have that as a possibility hanging over their head. So there's some other reasons to be looking at that. Then on the question on the rental real estate part of property, if it's in your name, again, if the loss is $10,000 and you're filing a joint return, that $10,000 shows as a deduction on your joint tax return, whether it's from you or wherever that may have come from, as long as you're a member in that entity. And then I talked about the K1s. If it's in a partnership structure, and that $10,000 loss is now split 50-50 between myself and my spouse, Well, I still have that $10,000 loss. It's just showing on two separate K1s. One comes in at 5 and the other one comes in at 5, and it's still $10,000 of loss that I can take on my tax return as a full deduction, assuming that I made the election to treat the spouse as if she's a professional as well, which I can do. Again, that's something you need to talk with your accountant about. It's a one-time election saying that we're going to, you know, what I do in the real estate world for rental properties, tax onto whatever my spouse may have, and they're going to, for rental property purposes, be treated as professional as well. That way they can deduct it. If not, then that $10,000 loss, I can take my $5,000 loss as a real estate professional, but my spouse can't. It just carries over. I don't lose it. It just carries over until sometime down the road they're able to utilize it. Does that help?
Yes, thank you.
Okay.
Jerome, we had a question in the chat from Bonnie. She asks, are you better covered in a partnership than a sole proprietor?
Yeah, and again, from a tax standpoint, it's pretty much the same. Usually people will do that, set it up as an LLC. And I kind of hit on that a little bit about, you know, would I do it? I probably would, just because there may be some chance, if I'm getting sued by somebody, that perhaps I can keep a piece of what I have outside of the that lawsuit. May not always happen. From a tax reporting standpoint, pretty much the same. If I'm in a partnership, and I made $50,000, whether it's in a partnership or in a sole proprietorship, my tax is the same. I got to pay income tax, and I have to pay self-employment taxes on that full $50,000, whether it's a sole proprietorship or a partnership. And that's because of, as a realtor, personal services is what my business is, and so that makes it subject to self-employment tax. If I'm renting property, if I have an investment property, that $50,000, if I make $50,000 from a rental property, even though I'm a real estate professional, is not, that $50,000 is not subject to self-employment tax, just income taxes. So, anything else? All right.
No, we just have a thank you from Adrian for sharing your information today. It was very helpful.
Not a problem.
Yes, and a big thank you for joining us. And just a reminder, all of Jerome's information is in the chat, so make sure that you grab that. And this recording will be available on our YouTube channel at some point here after the meeting. So if there's something that you missed and you want to go back and watch again, you certainly can. Thank you. Thank you so much for joining us today, Jerome. We so appreciate it, and we look forward to seeing you next time.
All right. Thank you. Take care.
Absolutely. Take care, guys. Have a good afternoon.
Thank you.
Bye.
See you later.
Thank you.